Hello, my name is Lucas de Paul Bay, and I'm pleased to be joined here with Paul Taylor and Zara Lyons, our portfolio managers for our Australian equities capabilities. And we'll be talking about a stock that is loved and hated by many, CBA. And CBA has been a stellar performer over the last 4 months. I believe it's generated plus 40% in terms of returns, including dividends, over the last 12 months. So great performer and a great outcome for those people that have held that stock. And I know it is a stock that both of you do like, but if we reflect on that performance, maybe Zara, take us through what has been some of the key drivers of that performance.
Thanks, Lucas. Well, the key thing initially has been that banks generally have rallied when you have an RBA rate cutting cycle, and that's because lower interest rates help stimulate credit growth, as well as improve the borrowing outcomes of customers, as well as improve their ability to repay the existing debt. So you see a more benign credit cycle. So that's sort of the first factor, and we did see that play out through the year. In addition, there are some nuances for CBA. Well, aside from having very strong operations, so it sort of has 34% share of Australians as the main financial institution, which is a tremendous franchise advantage, scale advantage, which helps them defray costs across a much broader customer base. But setting that to one side, they've executed very well over the years, paid out more capital in terms of capital management, issued fewer shares than the competition. So that's created a growing valuation premium gap to its major listed banking peers. Excuse me. The other factors are technical things, such as, so in 1991, CBA floated. I think it was around $5.40. And if you do the math on that, it's probably up 30 times. So that is a genuine friction for the retail shareholders to sell and incur capital gains tax. Now, in terms of composition of CBA's shareholder base, when it was listed, I think it was about 56% was the share that was allocated to retail shareholders. That has subsequently reduced over the intervening period, and now it's around 47%. Right. But why am I saying that? Well, because when you put aside the index funds, which are about 30% of the shareholding, and then other sort of sovereign funds and so on, there's actually a fairly small amount of active institutional investors. It's sort of less than 10% of the shareholder registry that can buy and sell those shares, which is quite different to the other listed major bank peers. Okay. Or even if you look at the index more broadly, the ASX 200 index, it's about 30% of the index is held by retail shareholders. So that creates a technical illiquidity in CBA, and it's a genuine friction for selling. Other factors have been just, the weight of money argument. Well, I should take a step back. Firstly, there's the index leadership. So currently CBA, well, about 12 months ago, CBA became the leader in the ASX 200 index and took that mantle from BHP, which had lost its number one leadership because of iron ore and commodity prices weakness. And that was the first time that CBA has been the leader of the ASX 200 since 2016. So that's been a long time, but between drinks. But in June, it reached about 12.5% of the index weight was CBA. So that's when you saw that real momentum squeeze pushing the share price up to like $191, I think, towards the end of June, you'll recall. And some of those factors, as I described the shareholder base, and the index money pushing through, that you've seen the Australian super funds getting larger, you've seen the superannuation guarantee contribution increasing in a staged effect over the last 5 years, and in July it went up to 12% of the annual payroll. And then what was the other point that I had to make about that? Oh, and that the Australian superannuation funds they do tend to exhibit a large Australian domestic home bias relative to other funds globally. So, and the reasons for that is that we do have good corporate governance, great dividends, franked dividends, so there's tax advantages there. So the confluence of all those factors, I think, have been very supportive to Commonwealth Bank, and frankly, they just haven't disappointed in terms of execution. They were one of the only banks that were having earnings growth through and earnings upgrades through consensus upgrades over the last 12 months. So that's been really positive relative to the peers. So that was, in a nutshell, the 10 reasons why CBA has sort of outperformed peers. But what we're seeing now is that usually, because the CBA is off-cycle reporting with the other major banks, which all report, they're not June year-end, they're September year-end, so they will report in November. And you do tend to see a little bit of a flow out of CBA and into the other banks around this time because of positioning for dividend flow.
Right.
So that's a fact that has been around for a number of years. And then what we see conversely back after the other banks reported in May, then you see a bit of a flow back into CBA. So we do see that phenomenon happening a little bit as well.
Mm-hmm. So it's been quite interesting. I mean, that's very insightful because I didn't appreciate to what degree, obviously you've got the fundamental strength, but also these technical factors which certainly can impact the direction of share prices. So if we look, with a lens going forward now and you think, okay, well, we understand sort of what's driven the performance over the last 12 months on a forward-looking basis, and maybe to yourself, Paul, why do you like the company and why do you continue to hold the company? Because one of the sort of obvious questions is how do you marry the quality of the company with the price of the company? Because as the price has gone up and as you've had this strong performance, obviously you've seen price to earnings multiple go up as well. And a lot of investors are in this conundrum of saying, well, we like the growth, but the price is here. How do I marry those two things together?
Yeah, I guess maybe the first point is, typically I'm always looking for businesses that are high return on invested capital businesses that can reinvest at a high rate. Right now, that is Commonwealth Bank. It is the standout. It's got the highest return on equity or highest return on invested capital. And now when you've got that, you normally get upgrades, and that's just that's how you create value. So I've got an overweight on CBA, but I've got an underweight on the bank. So I have some sympathy to the fact that maybe the banks are expensive, but I think CBA really is to me, they've almost got an unfair advantage, and the points Zara is talking about. 35% of Australians have their primary financial relationship with CBA. 67% of new immigrants have their bank account, and that's our population is growing by these new immigrants. So they've got the same platform as everybody else, but they've got more people on that platform. So structurally, they've got an unfair advantage. Their retail deposit base is bigger and it's lower cost. So they pay less in term deposits and interest rates, and people want to be with that bank because it's the safest. CBA is seen as the last bank standing. In the global financial crisis, all deposits were heading to CBA, even out of the other big banks. They were heading into CBA because the market sees it as the last bank standing. Wholesale costs are the lowest. So CBA gets the lowest rate for their wholesale funding as well. And then I also look, when I go forward, when you start to look forward, I sort of think, well, actually challenges are probably not going to come from a new bank starting up. They're probably going to come from technology companies. So, the technology companies are already playing in the sort of payment system, and that could expand further. And CBA has by far the best technology platform. So I look at it and think, well, actually, if the threat does come from the technology companies, CBA is in a much better position to withstand that threat from technology companies, whereas the other banks are, in a less good position. And that, I think that's a multiple year advantage for CBA as well. So I actually think CBA almost has an unfair advantage in the market.
Mm-hmm. So if I sort of summarise this, and you correct me if I'm not getting this right, but you're saying that the structural strength that the CBA has, the growth profile, the investment in things like technology. So those things, despite sort of where the valuation's at, that growth, you've got confidence in that sort of growth and quality element of the company.
Yeah, it's got the growth, it's got the returns. That is reflected in the valuation, but to me, that's just a reflection. Of their superior position to the other banks.
Yeah. And Zara, from your perspective, how are you thinking about those two things, marrying up the sort of attractiveness of the company and the valuation? Because again, it's a challenge, right? How you sort of
It is a
judging
challenge.
those
I
two
mean,
things.
it's not lost on anyone who looks
Yeah.
at the markets closely that
Yeah.
CBA is, from a multiple perspective, is an expensive multiple, and the divergence between it and its peers is big. What was interesting to me this reporting season about CBA was that they talked about their a partnership with OpenAI and that they're actually allocating some investment dollars to trying to understand how they can introduce AI into the business. And I suspect there's probably at least 100 use cases for AI to be used across the bank to improve the cost base, improve the monitoring, lots of different elements, HR, compliance, legal, number of different avenues where they can improve their costs. So, and bear in mind that CBA or none of the banks actually provide any earnings guidance at all. So the investors rely on the consensus estimates, and consensus estimates are literally made up of the estimates of everybody, and no one really has any idea what sort of benefits things like AI and technology spend will confer on the business.
But they're investing in that technology, which is quite interesting.
Yeah.
So
and they're in that position because they've been investing consistently for a very long time, relative to peers that may have underinvested because they've had other fires to fight in terms of capital problems and challenges and so on, or acquisitions to digest. So it does create quite a marked difference between CBA and the others.
So final question from me, if you were to sort of think about, again, looking ahead, what are the three things you want to sort of see from CBA in the next 12 months to sort of reinforce that confidence in the company in terms of whether it's execution, whatever it may be? What are some of those things you're looking at?
Well, to me, it's about maintaining their position. They're the clear market leader. They're the clear quality bank. I guess I want to make sure that they maintain that lead over the other banks. So continue to invest in technology, continue to invest in their position, and not really give the other banks a chance of catching up.
Zara?
Yeah, I would concur. Certainly having market share, holding or gaining market share in terms of the value of the customer rather than necessarily share for share's sake. And potentially some sort of productivity benefits from the investment dollars that they're spending, whether it be AI or other areas. So just seeing that leverage coming through, and also just managing the credit cycle, which, we've had a fairly benign credit cycle because unemployment rate's been low and house prices have remained very high. So it's been the most unusual credit cycle of credit cycles.
Well, thank you very much. That's been very comprehensive and very insightful and certainly a lot of listeners will be interested given that it is such a topical stock. So thanks for your time.
Cool.
Pleasure.
Thank you.